So, you want to own a title loan business. Before we start, here's a number. The average title loan in America is about $1,000. The average borrower pays $1,200 in fees on that $1,000 loan. Not over the life of a mortgage. Over 1 year. That is, a 120% return on a single loan, renewed month after month, by a customer who cannot afford to pay you back. And that is the entire business model. More than 2 million Americans use auto title loans every year. They hand over the title to their car, their most valuable possession, in exchange for a few $100s in cash. They keep driving the car. You keep the title. And every 30 days, they owe you another round of fees. Across the industry, borrowers pay roughly $3 billion a year in fees alone. Not principal, fees. On loans that average under $1,000. So how do you get into this business? What does it cost to open a store? How much do you actually make? And why has the majority of the country decided this business should not exist at all? Let's start with the entry price. The startup costs for a title loan shop are shockingly low compared to almost any other financial business. You can open a single storefront for somewhere between $25,000 and $50,000. That covers your state license, a lease on a strip mall storefront, basic office furniture, a computer, loan management software, insurance, legal setup, and enough operating capital to start making loans. Compare that to a bank, where the FDIC wants $20 million in regulatory capital before you're even allowed to open. Compare it to a McDonald's franchise, where you need at least $500,000 of your own cash and 2 years of toilet scrubbing before they'll consider you. A title loan store costs less than a food truck. And unlike a bank, you do not need a federal charter. Unlike a franchise, nobody has to approve your character. You need a state lending license, a storefront, and a vehicle appraisal process. That's it. But here's the catch that shapes everything. Title loans are banned or effectively prohibited in 33 states and the District of Columbia. That is not a typo. The majority of America has looked at this business and said no. New York, California, New Jersey, Massachusetts, Colorado, Connecticut, Maryland. These are not small markets. These are the largest consumer economies in the country, and you cannot operate in any of them. Your entire business is confined to roughly 17 states where the law allows it, plus a handful of loophole states where lenders have found ways to operate around restrictions. Georgia, Texas, Tennessee, Mississippi, Alabama, Arizona, Delaware, Utah, Nevada, Missouri. These are your markets, which means your addressable customer base is not 330 million Americans. It's the population of the states that still allow you to charge 300% interest on a 30-day loan, and that list is getting shorter, not longer. Now let's talk about what the product actually is. A title loan works like this. A customer drives into your parking lot. They own their car outright, no existing lien. Your employee inspects the vehicle, appraises its value, and offers the customer a loan for somewhere between 25% and 50% of what the car is worth. A car worth $4,000 gets a loan of $1,000 to $2,000. The customer signs over the title. You place a lien. They keep the car. They drive away with cash. The loan is due in 30 days. The typical fee is 25% of the loan amount per month. On a $1,000 loan, that's $250 due in 30 days, plus the full principal. Now here's where the math turns. The customer borrowed $1,000 because they didn't have $1,000, which means in 30 days they almost certainly do not have $1,250. So what happens? They renew, they come back in, pay the $250 fee, and the loan resets for another 30 days. Same principal, same fee, same deadline they cannot meet. According to the Consumer Financial Protection Bureau, more than 80% of single-payment title loans are renewed the same day they come due, not most. 4 out of 5. The borrower walks in, hands you $250, and walks out still, owing the original $1,000. They have paid you 25% of the loan and reduced their debt by 0. And this is not a failure of the system. This is the system. More than 2/3 of all title loan revenue comes from borrowers who renew 7 or more times. These are people trapped in debt for the majority of the year. The CFPB found that loans paid in full with a single payment, the scenario the lender advertises, make up less than 20% of the business. Your most profitable customer is not the person who borrows $1,000 and pays you back. Your most profitable customer is the person who borrows $1,000 and pays you $250 a month, every month for a year. That customer has now paid you $3,000 in fees and still owes you the original $1,000. The annual percentage rate on that loan? 300%, sometimes higher. In states like Utah, there is no cap at all. So what does the lender actually make? Let's run the math on a single store. The average title loan store serves about 300 unique customers per year. That's roughly one new customer per business day. Each of those customers carries an average loan of about $1,000 and pays roughly $1,200 in annual fees. 300 customers times $1,200 in fees. That's $360,000 in gross fee revenue from a single storefront. Now subtract your costs. The nation's largest title lender, TitleMax, which operates over 1,000 stores in 17 states, reported spending about 66% of its revenue on overhead. That includes rent, employee salaries, software, insurance, and compliance. Another 18% goes to loan losses, the customers who default and whose cars you repossess and sell. So, roughly 84% of revenue goes to operating costs and losses. That leaves around 16% as net margin. On $360,000, that's roughly $57,000 in profit from a single store in year one. That sounds modest, but remember, you opened this store for $25,000 to $50,000. You are approaching break-even within 12 months on a financial services business. By comparison, a McDonald's owner waits 6 to 7 years to recoup a $2 million investment. And the math scales. TitleMax's parent company, TMX Finance, reported $910 million in revenue in 2019. Even at a 16% margin, that's north of $140 million in profit. From a business that lends people $1,000 at a time. This is where the video would normally transition into why this is a smart business to own. This is not that video. Here is what happens to the 300 people who walk into your store every year. Half of them are not using the loan for an emergency. According to Pew Research, 50% of title loan borrowers use the money to pay regular monthly bills. Not a car repair, not a medical crisis. Rent, utilities, groceries. They are borrowing against their car to buy food, and you are charging them 300% to do it. The average title loan payment consumes 50% of the borrower's gross monthly income. That is not a manageable debt. That is a debt designed to be unmanageable, because an unmanageable debt is a debt that renews, and a debt that renews is a debt that generates fees. 1 in 5 title loan borrowers will lose their car. Not 1 in 100. 1 in 5. According to the CFPB, 20% of single-payment title loan borrowers ultimately have their vehicle seized for failure to repay, and 1/3 of those borrowers had no other working vehicle in their household. Think about what that means. A person borrowed $1,000 against the only car they own. They paid you $2,000, $3,000, sometimes $4,000 in fees over the life of the loan. And then you took their car. They now have no vehicle, no way to get to work, and they have paid you several times the value of the original loan before you seized the collateral. In Georgia, which is ground zero for the title lending industry and home base for TitleMax, the law allows lenders to charge repossession fees of $250 plus $5 per day in storage fees on top of the 300% interest. And if the repossessed car sells at auction, for more than the loan balance, the lender keeps the surplus. The borrower gets nothing. This is the business you are asking to enter. Now let's talk about what the government has done about it. In 2016, the Consumer Financial Protection Bureau fined TMX Finance, TitleMax's parent company, $9 million. The CFPB found that TitleMax employees were presenting borrowers with a document called a voluntary payback guide, which showed customers a schedule of smaller monthly payments spread over a longer period. The guide made it look like the borrower was signing up for a manageable installment plan. They were not. They were signing up for a 30-day loan, and the guide was showing them what would happen if they renewed it over and over again, paying fees each time. The document hid the true cost. The CFPB also found that TitleMax collectors made in-person visits to borrowers' homes and workplaces to collect debts, exposing personal financial information to employers, co-workers, and family members. That practice was ruled illegal. The fine was $9 million. TMX Finance's revenue that year was roughly $900 million. The fine was approximately 1% of annual revenue. The cost of doing business, but the CFPB wasn't done. In a subsequent action, the Bureau fined TitleMax an additional $10 million, this time for violating the Military Lending Act. The MLA caps interest rates on loans to active duty service members and their families at 36%. TitleMax was charging military borrowers nearly 3 times that cap. And when the company identified that a borrower was a service member, employees were found to be altering personally identifiable information, doctoring the records so the borrower would not be flagged as military. They were not just overcharging soldiers, they were covering their tracks. This is not an industry with a few bad actors. This is an industry whose largest company, operating over 1,000 locations, was caught twice by federal regulators within a few years, fined a total of $19 million, and continued operating with barely a pause. And then there's the regulatory direction. 33 states have already decided this product should not exist. Among the states that still allow it, the trend is toward tighter restrictions, not looser ones. Interest rate caps are being introduced or lowered. Rollover limits are being imposed. Mandatory cooling-off periods between loans are being written into law. If you are opening a title loan store today, you are building a business on ground that is actively shrinking underneath you, and the customers know it. When Pew surveyed title loan borrowers, the majority said they believed the industry should be more regulated. These are the people using the product, and they are asking for someone to stop them from using it. That is not a sign of a healthy market. That is a sign of a market where the buyer and the seller both understand that the transaction is harmful and neither one can stop. So let's pull it all together and answer the question. If you open a single title loan store in a permissive state, Georgia, Texas, Mississippi, you can realistically generate $300,000 to $400,000 in annual revenue on a startup investment under $50,000. Your net margin after overhead and losses will land somewhere around 15 to 20%, giving you $50,000 to $80,000 a year in profit. If you scale to 10 stores, you're looking at $3 to $4 million in revenue and $500,000 to $800,000 in annual profit. If you scale to 50 stores, you're approaching a mid-sized regional lending operation with revenues in the tens of millions. The ceiling exists. TitleMax proved it. $910 million in revenue from a product that averages under $1,000 per loan. The math works if you can stomach it. But here's the deflating truth. If you took that same $50,000 in startup capital and put it into an index fund 20 years ago, you'd have roughly $400,000 today with no employees, no strip mall lease, no state regulators, no CFPB consent orders, and no days spent repossessing a single mother's Honda Civic because she couldn't pay you back the $1,000 she borrowed to keep the lights on. The title loan business is one of the highest margin, lowest barrier financial products in America. It is also the only financial product where the majority of your customers will tell a surveyor, on the record, that they wish you didn't exist. You can make money here. The question is whether 10 years from now, the money will have been worth what you did to earn it.